let's talk about how to legally know if a company might miss earnings by a lot and how to understand how much the stock should go down on an earnings miss. Now, the way that we do this and the way that we know that a company might miss earnings by a lot is the first sign is this. The company's earnings press release has not come out yet, okay? Meaning the date for when they're going to report earnings. They usually issue two press releases, one saying, here's the day we're going to report earnings, and another one, the day of earnings, saying, here's what our earnings were. Okay, so the way it works is with many, but not all companies, with many companies, every 3 months, meaning every quarter, they issue a press release. And the press release just states what day they're going to release earnings. Now, if a company is going to miss earnings by a lot, then in that press release that they issue, the company is going to mention the earnings date and how much they're going to miss by. Okay, and this is called a negative earnings pre-announcement. And every company has a very different pattern for when they usually set their earnings date. For example, if company X usually sends out a press release a couple of days after the quarter has ended saying this, we're going to release earnings on this date, and here's the webcast address to join us for our earnings call. But you then notice that, oh my gosh, it's now been 1 week since the quarter ended, and there's no earnings press release yet about the date of the earnings call. Then it might be because the company's accountants are scrambling, trying to see, how much they're going to miss earnings by for that particular quarter. So it can take a couple days for the accountants at a publicly traded company to talk to their CEO, CFO, and the investor relations team and figure out what to say in a press release like this. Given the tough economic environment, we expect to report revenue and earnings below our previously guided range. The earnings are going to be this probably, and the earnings date will be on whatever date they state. Okay, that rhymed, I know. And hedge funds make billions of dollars every year by tracking stuff like this very closely. Now, if the company's negative earnings press release comes out after the market closes, then quite often the stock immediately drops by the magnitude of the earnings pre-announcement miss. Okay, it drops immediately after hours. For example, if a company issues a press release saying that they're going to miss earnings by 20%, then what happens is the stock often gaps down about 20% per the gap here in this chart. Why does that happen? Well, it happens because professional investors have financial models, and quite often their target prices are based on a price to earnings multiple. So for example, let's say that an analyst at a mutual fund company called Fidelity has a price to earnings target of $100 on a company, and they base that on, let's say, 20 times earnings per share. This means that they think earnings will be $5 per share. So $5 per share times a price earnings multiple of 20 times implies a $100 target price. Now, if the company negatively pre-announces and says that they're going to miss earnings by 20%, then the analysts will update their financial model at the mutual fund as quickly as they can. And as the numbers filter through their income statement in their financial model, the $5 drops by 20% immediately to $4. Then the analyst thinks the company might still trade at 20 times earnings. And 20 times $4 in earnings results in a target price of 20% lower, meaning $80 instead of $100. So from a fundamental and valuation-based perspective, the analyst tells their boss, the portfolio manager, or their trader to sell the stock after hours if they can find somebody to buy the stock above $80. Now, as a very quick side note here from a technical analysis perspective, there's now what's called a gap in the chart. So what does that gap mean? Well, it means that in the future, like in maybe 3 or 6 months, if the stock is volatile, in the future, many traders think that the stock is oversold and must go up to close this gap before it can resume trading down. I know this sounds out there, but this strategy quite often works well for traders. Okay, so in my MBA program, I teach you about fundamental analysis, valuation-based analysis, and technical-based analysis because there's demand for it. Now, from a behavioral finance perspective, we have to understand and do research on historically how many days after a quarter ends does the company issue their press release confirming the day of their earnings call. And we also have to track if they've missed in the past, do they issue a negative press release 5, 6, or 7 days after the quarter ends? This pattern recognition works exceptionally well. So let's now talk about ways to find out if a company might miss earnings, okay, other ways. So on the income statement, we have revenue, right? It's at the top. That's why they say what's your top line, because that's revenue. And the bottom line is earnings. That's why they say what's your bottom lines. So at the top of your income statement, you got revenue, which means how much a company has made after, this is crucial, after they deliver the product or service to a customer. Okay? You can't recognize revenue until you deliver the product. So quite often, customers pay well in advance of receiving products or services. And this cannot be classified yet as revenue by law, as the company has not yet delivered the product or service to the customer. Therefore, it cannot go on the income statement. Instead of going on the income statement, what happens is that revenue goes on the balance sheet as a liability called deferred revenue, okay? Because the company is liable to deliver the product or service to the customer in a future quarter. This is crucial, and hedge funds make a fortune by analyzing this, and you can as well. So if you notice that the company's deferred revenue historically grows at the exact same rate as revenue, okay, and one quarter you see that revenue from the income statement went up 15%, but deferred revenue on the balance sheet went down, then this means that there's a very high chance that the company is going to miss revenue next quarter. So how does this usually happen? Well, here's what happens. Let's say I work as a salesperson at a publicly traded company, and my quota for sales is $1 million per quarter, and we're almost the end of the quarter, and I'm way behind schedule. What I, as a salesperson, might do is I might call, and this happens all the time, I might call my best customers and tell them, hey, I need a favor. I'm kind of stuck here. Can I sell you and deliver to you more stuff this quarter, please? And let's say the customer says, okay, and I sell and deliver the additional products or services to them this quarter. Well, what happens is this. This likely means that the customer is going to spend less than usual with me next quarter, as they have their own budgets too. So what is the mathematics that you use to monitor the change in deferred revenue? Let's go through this. Well, it's called bookings. And we have to thoroughly understand and monitor this for any company that we invest in. And quite often, companies will make revenue and earnings, and the stock will go down, and we don't understand why. A lot of times it's because of bookings, and here's the math behind it. So bookings equals revenue from this quarter just reported, plus the deferred revenue on this quarter's balance sheet, minus the deferred revenue on the previous quarter's balance sheet. Okay, so bookings means revenue, which you can see there, revenue for this quarter in the income statement, plus the change in deferred revenue. Okay, so the last thing I want to say about this is on the topic of hedge funds is what hedge funds do is they rent satellites. And they rent these satellites to count the number of cars sitting in parking lots on the last few days of every quarter for companies they invest in. Now, if the number of cars is a lot higher on the last day of a quarter than usual, especially if it's a weekend, it means that the company might miss earnings. And I think it's only a matter of time until governments make this illegal, because it's not fair that large hedge funds get this information and retail investors like us do not. Now, if this was helpful, please like and subscribe, and thank you as always.